Good day, everybody. Welcome back to my channel where we talk all things finance and investing. In today's video, I want to touch on the subject of Berkshire Hathaway, Warren Buffett's company, that has increased its cash holdings on the business up over $325 billion, an incredible amount, more than they've ever had. It's actually up 17% from the second quarter. So this is a big deal. It's made a lot of news headlines recently, and what does it really mean? That's the subject of today's video. Okay, so for anyone who's not aware, who is Warren Buffett? Well, Warren Buffett is probably the most seasoned, most famous, and one of the most successful investors of all time. If you're interested in finance and investing, I highly encourage you, if you haven't done so, to look up Warren Buffett, read his stuff, his annual letters to shareholders in particular, really fascinating. But he's had an incredible record going back to 1965, where his returns of Berkshire Hathaway, based on his investments in businesses, has returned around 20% per year, going back all the way to 1965, like I mentioned. To put that in perspective, the S&P 500 in that time has returned around 10%. So he's actually double the performance of the S&P 500. For that length of time, going back to 1965, that is an incredible achievement and incredible return. So he's considered kind of the most successful investor of all time for that reason. So that's Warren Buffett. So we've seen recently with company filings that Berkshire has increased its cash position up to over $300 billion, much more than the company has ever had. But before we dig into it, we need to understand one thing. This amount of cash, how much is that relative to the size of the business? Because of course, if the business has grown an awful lot as well, then cash as a percentage of the total assets is something that we would look to see and you would expect to have increased. We actually see that the cash holding of $325 billion right now is actually around 28% of the total assets of Berkshire Hathaway. So even on that metric, it's incredibly large compared to how it's been in the past. So what are the reasons that Warren Buffett has gone to hold so much cash? Because he's not really come out publicly and explained his reasons for this. But as someone who's watched Warren Buffett for pretty much my entire 20-year career, I've seen almost everything he puts out, loads of videos, read his reports and everything. I've got a few ideas, I think, on why he's done this. One reason in particular, in my opinion. You see, Warren Buffett is the ultimate value investor. His entire career, his investment thesis has been around valuations. By valuations, he prefers to buy great companies at a great price, on the cheap if you like, and then he prefers to sell these companies' stocks when the market is getting extremely overvalued or there's a lot of greed that he sees in the market. And to me, that is the only thing that determines Warren Buffett's decisions when to buy or when to sell. So he's the ultimate value investor. So one of the most popular indicators of valuations used by Warren Buffett is actually called the Buffett indicator. And what that is what is the value of the entire stock market? And for that, it's typically used the Wilshire 5000, which is all 5,000 companies listed in the US stock market, and compare that to the size of the GDP in the US, gross domestic product, really the size of the economy. And depending on the ratio of that, we can get an idea of how overvalued or undervalued the stock market would be. Well, at the moment, the ratio of stock value to GDP in the US is around 208%. So therefore, we can see that the relative value of the stock market versus US GDP is actually quite high at the moment, very high and near all-time highs. This is a very simple way to get an idea of valuations, but a very useful one. And one that Warren Buffett has been known to use. He's actually said in the past, it's probably the best indicator of where valuations are at any given time. Another valuation that he likes to use, very simple way to do this, get an idea of valuations here on the market, is the earnings yield. So what you would do in this case, you would take the S&P 500 earnings per share, the amount of money per share basis that all S&P 500 companies earn, and you would calculate that up against the total value of the S&P. Okay, so right now the earnings yield on the S&P 500 is around 3.28%. Okay, now if you compare that to the 10-year yield, for example, which is government bond yields, and the 10-year is the benchmark, well, you can get a 10-year yield of around 4.2%. So if the S&P 500 earnings yield is 3.28, the 10-year yield is around 4.2, then that gives you an idea that stocks are quite a bit overvalued relative to the 10-year government bond. So perhaps it would be wise to shift some money into bonds in that case and pick up that additional yield, waiting for valuations to come down. Ultimately, this comes down to Buffett's methodology, one of his best quotes of all time. And in my opinion, if you take this and nothing else from this video and you act on this, Buffett's quote is to be fearful when others are greedy and greedy when others are fearful. You could probably say right now, given everything that's going on in the stock market, crypto markets as well, although that's a different animal, but it's a risk-on asset and something we can use to get an idea of greed and the risk appetite of the market right now. You could probably say that the market is in a phase where people are being greedy. And according to Buffett, it's time to be fearful when everyone else is getting a bit greedy. So does this mean that Warren Buffett sees a crash around the corner and therefore he's liquidating all of his positions like we've seen him do with a lot of stock in Apple and Bank of America recently? Well, not really. Warren Buffett has admitted himself he's not smart enough to time the market. He's much more of a believer that time in the market beats timing the market. But in my opinion, the number one criteria that he uses for his decisions, like I said, is valuations and nothing else. He can't call a top, he cannot call a bottom, but what he can do is get an idea of where valuations are, and if they're extreme, he feels more comfortable raising cash and keeping that for at a time where valuations shift back down. He believes that the market gets overly optimistic at times and overly pessimistic at times, and that is a great chance to make some money in the market. Buffett last increased his cash levels quite a bit around a year or two before the global financial crisis, so that tells you he knows he cannot time the market perfectly. Nobody can. Neither can you, so don't try and do that. So what can you do? You've seen this now. Warren Buffett's raised big cash amounts. For me, this is a red flag for the markets. If you saw my videos over the last 2 weeks, the Goldman Sachs forecast over the next 10 years is absolutely dreadful. 3% return they're forecasting each year for the next 10 years. So what can you do? The simplest thing to do is something similar to what Warren Buffett has done. Reduce your equity exposure. If you're holding index funds or ETFs or individual stocks, you can consider selling some of those down and turning those into cash, which you can then reinvest into bonds. If you're in US dollars, you could look at buying US Treasury bills. That's what Warren Buffett has done with the cash that he's raised. Treasury bills are bonds, government bonds, that will mature in 1 year or less. So you have a much less risk here of where interest rates might go in that time period. It's a very easy, quick way to park some cash and pick up some interest. So US Treasury bills could be a place that you could go. So take a look at your portfolio. How much do you have in equities versus cash, for example? You can raise that up. If Buffett has gone to around 28% cash to total assets for Berkshire Hathaway, maybe you could consider going to 20, 25, or 28% as well. If you're in the UK, you could buy short-dated government bonds or government gilts. Same thing, mature in a year or less, and then you can reevaluate in that time. Another thing you can do, and this is an option you have that Warren Buffett does not have, and you could look at cheaper parts of the market. One area in particular are small cap stocks. These are the shares of smaller companies. They're a little bit riskier, a little bit more volatile. They have a little bit more debt than the large companies in the S&P 500. But they are better value right now than the large caps. So this could be a place that you put some cash. Buffett does not have this as an option. Why? Because the numbers he deals with are just so big. He cannot go out and buy small cap companies. It will move the market so much that he just can't do it. It'll push the price up, and when he sells, it would push the price down. And he would also run into problems with liquidity if he wanted to sell out. So small caps are not an option to him, but they are an option to you. I recently did a video on small caps. If you want to learn more about them, link in the description. Watch that video. It'll give you some inspiration as well on exchange traded funds that you can use to get exposure to small cap stocks. That's an option that you've got as well. Another thing you can do is just ignore it all and push forward. Automatic invest into the market, index funds and ETFs. Don't worry about where the market is right now or where it's going to be in a year or two time. The reality is absolutely nobody knows where the stock market will be in a year or so. It's just impossible to predict. If you're younger and you're in your 20s and 30s and you're just starting out, for example, you've got a long investment horizon, maybe you're investing for retirement, you've got another 30, potentially even another 40 years to go, you shouldn't worry about this at all. In fact, continue with your automatic investments into the stock market and just carry on as normal. If the market does sell off and you have some cash sat somewhere else, then maybe that would be a time to allocate it. But for the most part, the important thing is that you're automatic investing in each month. Buffett has said one time, for the average investor, just buy the S&P every month and do it through thick and thin, especially thin. I think that's absolutely great advice that anyone should go by. So that's my video on Warren Buffett's cash pile. It is definitely something to be paying attention to. It got me thinking a lot where we're headed in the market. For sure, when Warren Buffett goes to so much cash, 325 billion, versus where he's been historically around 150, 170, even at 200, it is a big deal and it is a red flag in my opinion. But don't worry about it if you're younger. If you're concerned, go to cash a little bit, buy some short dated bonds or look at small caps. Let me know what you thought of the video. Leave me a comment. What do you think? What do you think Warren Buffett has gone to cash so much for? What would you like to do to work around that, if anything? Let me know in the comment. Also, if there's any other topics you want me to cover, put a comment in there. Please like, subscribe if you haven't subscribed already. A lot of my viewers are not actually subscribers, so hit that subscribe button. It would really help me out. Really appreciate that. And as always, all the best in your savings and investment journey.